As you all know, my name is Punti, and this is the FAC1502 class. And today we will be focusing on topic B, as I've told you the last week. I hope you guys did the basics on topic A, but we'll try and reverse that. We're not going to be rude. We'll try and reverse that, and we'll test if you guys understood what I did the last week in the class. Okay, but the focus today will be on topic B. I think it contains unit 5 up until 7. Okay, that's going to be our segment for today. Sorry, this flu is showing me a bit of flames. I got an email from someone last week. He said that he bought the book, and I think he was not aware that the textbook is actually not compulsory. What I know is I've read somewhere where they mentioned that there's no textbook. Is it me only who saw that in the study guide, or is anybody who can validate what I'm just saying now? Tutorial letter textbook, tutorial letter study guide. I think there's somewhere where they wrote, I just forgot to actually page up to that part, but I've seen somewhere where they meant, unless if I'm confusing tax and accounting, but I've seen somewhere where they said
there's no textbook for this.
Sorry?
There's no textbook for this. It's
all right.
okay.
I hope you have sent me the email last week regarding the textbook. That has just been validated. John has just said that there's no textbook for this content.
As far as I know, I haven't seen that there's a key reference, no textbook for this year. So
yeah, but I've also seen it somewhere where they said that there is no textbook for. I just didn't have much more time to go through the study unit. Okay. So since nobody has questions with regards to the work that we did prior to what we're going to do today, I think we just have to carry forward with the work for today. Okay. But if you realize some questions through along the process of the work for today, then you can actually let yourself in. It's fine. Everybody's welcome to be in our pictures today. Right, looking at your study guide, that entails part of your topic B today. We've got 3 learning units. The first one is going to be, I think it's collecting and processing of the accounting data for an entity. Let me just open up my page so that you can see my summary of notes. Okay, just a moment for me. Just want to open you. All right, good. So I would assume that everybody, Mr. Makaro, I would like you to actually add up on this one. It means that if you see my notes, it means everybody else must be seeing that. All right. Starting off with topic B here, we say the collecting and processing of the accounting data of an entities. So that's your learning unit 5, starting with the processing of, the accounting data there. Number 2, we've got an accounting cycle. It's not only crucial for your exam part, it's only crucial for your knowledge to understand the process in terms of how the transactions start and how is it finalized. Okay, so I've seen many of your questions in your assignments where you have to know what they would do is they would give you a question based on the accounting cycle, and they would give you like 4 different answers, A, B, C, and D, right? And they're mixed with one that doesn't belong there, 2 that doesn't belong to the accounting cycle part. Okay, so it's important for you to know that there's no way you can record the transaction without the transaction taking place. Okay, secondly, you need to understand what are the relevant source documents for that specific transactions. So those that they've got an accounting background in high school, they know that the transaction must take place. There are going to be the source documents, and then we're going to record the transactions in our journal. Journal include, or we'll tackle that. I think that's part where I've written the types of journal that we will be doing in this content. Okay, just a moment. Post into the ledger accounts, meaning that every closing balance that you have as part of the columns under your journals will be posted through to your ledger accounts. And as I've always mentioned, that somebody is going to be appointed to prepare the financial statement, mainly those with the accountants. So the management of the firm, they are somebody senior about the financial accountant will be able to analyze and interpret the financial statement prepared by the accountant. And obviously we're going to have the management that are going to make that kind of a decision as to whether the financial statements are viable or not. Be careful of that. Accountants, they like it. They like it. I would like to assume that not only in the assignment, but in the exam. And sometimes they might ask you to actually, they might mix them or they might put them in order, but you just have to know which one is which, whether it's relevant or not. Okay. 3, they have got books of the first entry, and the importance of the journal entries arises because the recording of transactions in the ledger accounts would make it an easy or bulky or unmanageable. Imagine if you record the initial transactions under the ledger account, especially at corporates. It's not even going to make sense because it means that the ledger account is going to be bulky, which is why there's a process in terms of the accounting cycle as to where you have to start. And there's a second process. There's like the steps that has to be followed. So it's not easy to start recording the transaction via the ledger accounts only. So you just need to go through your journals first. Right. Number 4, it talks about the types of journals and its functions and its own source documents. So you got the CRJ and CPJ, which stand for the cash receipts journal and the cash payments journal. There we record all the cash in and out transactions for the company. Right. So any cash received, it will be recorded under your cash receipts journal, and every cash payout, it will be recorded under your cash payments journal. Right, as I was saying that under the types of journals and its functions, along with the source documents, you've got your cash receipts journal and cash payments. Those journals, they record the cash in and out of the firm. And we've got the purchases journal and the purchase returns journals, which record all the credit purchases and the returns transactions. So this is how you have to get to be careful. All transactions that are made on credit purchases, they're going to go through to your purchases journal, and all the transactions that are returns from the purchases journal are going to be recorded under your purchases returns journal. Sales journal and sales returns journals, they all record all the credit sales and the returns, meaning that if the firm is making a sale on credit, you're going to record that under your sales journal. And then if there are returns on those sales, then we're going to record them under the sales returns journal. General journal, which records any transaction that does not fit in the above mentioned journal. Okay. Transactions like your credit losses or the assets, they would usually go through under your general journal. I think you'll see that under the examples that we have. But underneath there, we've got the source documents for your journals that would be as follows. CRJ, and the source documents is mainly your cash register roll or your duplicate of the receipt. That's your work to actually go through that. The CPJ normally is your check counter forwards and debit notes. In the purchases journal, we need the original invoices. And the returns, we need the original credit invoices. Sales journal, you need the duplicate of the sales invoices. And the returns, we need the original credit note. Okay. Just to verify that, just ensure that you go through your source documents now, because I'm not sure about my summary, especially under the sales returns journal. Trial balance, all the transactions that it records all the list of balances that is prepared periodically to determine any errors that might have occurred. Basically what they mean is sometimes we do certain accounts and then we record certain wrong accounts in that specific account. And at the end of the period, we transfer all of those list of balances under your trial balances there. So it contained of your debit and credit. However, they should be all equal, right? Meaning that if there's a discrepancy, it means that there's an error that might have occurred, okay? And that need to be rectified. But it's not a train smash. It does happen under theory or at your tertiary level, or even at work. It does happen, but that's why you've got the journal. So you will see that when you do it live at work, that was the main purpose of your journals, basically. So it's actually to record those kind of errors. Settlement discounts. Many of us do have accounts where they would constantly call you, firms constantly call you to say, how about you set your accounts and then we'll give you the discounts. I remember back then when I used to work for those that are staying in Johannesburg, there's a West Bank on the highway, it's combined with F&B. I was in the settlement sections. So basically, clients would say, I won the lotto, or I got my inheritance from my mother or my grandmother and stuff like that. I need to know how much is my settlement amount. And would give the client that settlement amount. They paid, we give them the original documents, which is called the notice for the car. Right. Of course, there's a turnaround in terms of validation of that settlement amount. Sometimes they tell you that it's valid for 48 hours, 24 hours, or seven working days. That will depend on the company policy. Right. So it will go in this way in terms of our theoretical plan. We grant and we receive. So the discount granted are often offered to the debtors to encourage them for quick settlements that are within their stated credit terms. Okay. And the received normally just for us to actually encourage quick income for the business. So that's mainly for the creditors. So your suppliers versus your debtors, they get difference in terms of how you grant or how you receive your the settlements. Okay, I just want us to actually invite SARS just for a little bit, which is your VAT, value added tax. It's usually called an indirect tax attached on any specific product or services at a rate of 15%, right? So, but here we're told that is levied at every point in production and distribution channel and is paid over 2 subs. So it's preferably paid in every 2 months over subs. Right. The categories would be as follows, where we've got your VAT output, which is based on the sale of goods or services. And then you've got your VAT input, which is based on the purchase of goods and services. I've noted something very important down there. It says, should your output be greater than your input, then the VAT vendor owes SARS. And the other way around would be if the input is greater than your output, it means that SARS owes you. That's basically when you are in business. Let's look at the registration process. Right, it is measured in accordance with your voluntary or compulsory, depending on how much the vendor is making on a yearly basis. Okay. So I don't think it's something very important for you at this point in time. When you do your tax on your second year, I've seen tax in first year VAT is out. So I think it's now being allocated in your second year or third year. You will see it when you cross that bridge. Right. However, VAT cannot be attached on product or service specific if the entity is not registered for VAT. Okay. So SARS, they call every business that is registered for VAT code named a VAT vendor. Okay. So if you are registered for VAT, meaning that if you've qualified to charge clients or be charged for that 15% there, then you would qualify for VAT vendor. That's how they're going to call you. Okay. So as you know that has increased by 1%, I think it was in 2018, if I'm not mistaken, to currently being at 15%. Okay. The reality is not every product attracts VAT. You can see that with your pork product, your maize meal, or your tin stuffs, and all of those. In most cases, they just sold as purely as they are. They don't attract VAT. Okay. So I'm going to move towards your accounting basis. So we've got 2 types of basis for the calculations of the VAT liability, which is actually on the invoice basis, and the other one is on the payment basis. So the invoice basis says that when you issue when the invoice, actually I was supposed to say only when the invoice are issued. So it will occur under your invoice basis. But when the payment is actually received, then it will be under your payment basis. Okay. So that will bring us to the end of our learning unit 5. All right. And I'm still going to emphasize this by saying that you need to read your theory. It's very important because you need to apply that when you do your practical work. Please make sure that I just don't understand why accounting students have a tendency of moving out your questions without reading. How do you apply? What are you applying when you do your questions without reading your theory? You deal with practical figures that has to be applied on the theory you have studied. It's very important. Please, you need to rush towards your understanding of theory than to understand your figures, because you will never know why are they recording these figures in a certain way. For you to understand why certain figures are raised in a certain way, it means that you need to read your theory. That means you give me the power to move on to learning unit 6. Right, we'll try and do one of the examples in the study guide. Just or just to make things look, just for things to look better. All right, let's move on to Learning Unit 6. Learning Unit 6 deals with what's called the adjustments, all right? So in terms of the adjustment, there are steps to be followed when you have to adjust any transactions. So it's very important for you to understand what are the steps to be followed for you to understand that kind of an adjustment. Basically, an adjustment means that you deal with a transaction that doesn't fall within the normal accounting period. Okay, it's either they're over or they are behind. Okay, so it's important for you to identify the account and look at the effect of the account to be affected and at what balances. And then you have to calculate the amount involved in the adjustments, right? And then afterwards, you need to record the necessary adjustments and ensure that all the balances are correct. Okay, let's have a look at number 2, where it says the short-term adjustments. That's where you need to apportion your income and expense received or paid in relation to earlier or later periods. It's exactly what I've just explained just now. But prepaid expenses. All right, let me just start over on number 2, which is the short-term adjustments. This is where you need to apportion your income and expense received or paid in relation to earlier or later periods. Okay, that's purely your adjustments in terms of the short terms. But number 1, we've got your prepaid expenses. We're talking expenses that are paid in the current period, but for the future financial period. Okay, mostly I know in this accounting they like insurance, or I think it's probably practiced in real corporate where companies are paying insurance in advance. I gave you a little example there, which you can also do it in your book. I just followed what has been done in the book there, but not exactly quite the same amounts. Right. Number 8, it says Puti Limited paid an amount of 7,000 Rand on the 1st of January for insurance to Dinana Financials. The monthly insurance amounts to 500 Rand. Okay, that's monthly. And the year end is actually the 31st of December. So automatically you'd know that it's 12 months period, starting from the 1st of January this year up until the 31st of December in this year. Let's look at how these has been recorded. So what you're going to do to determine the current insurance expense amount, you're going to say 500 multiplied by 12 is 6,000 Rand, which it represents your prepayment, okay? And you can see that there's an overpayment with regards to 7,000. There's something that I did wrong here with regards to an amount of 7,000 Rand. So currently, it means that we need to pay the insurance for about 6,000 Rand, but we overpaid with an amount of 1,000 Rand. That will be your incomes and expenditure account, prepayment. Right. So if you look at 6,000 Rand, the amount might be wrong or something. But if you look at 6,000 Rand, I said that it represents the prepayments, but it's important for you to identify that the prepayment goes under your statement of financial position. So just abbreviated there by SFP. So SFP, it means statement of financial position. That's your balance sheet in the olden times. Okay. And your 1,000 Rand, which would actually represent your income and expenditure account as prepaid expenses for the insurance, there would go under your normal profit and loss and other comprehensive income. That's basically your income statement. So you can see that we indirectly, so we have started to prepare what's called the financial statements in here, because we now can see that we've got the statement of financial position, and we now can see that we've got an income statement, which is a P&L and OCI. Okay.
Would that carry over to the following year then, that profit and loss? So that extra 1,000 Rand, just in theory, like with that extra 1,000 that you've paid.
Sorry, I didn't get I didn't get you there.
So that extra, the 1,000 that we overpaid, right? So we're listing it in the profit and loss, but in terms of the operation of the business, the following year, would that be owed back to us then from the insurance company? Is that,
yes.
In theory, that's how it would work, right?
That's basically how it works. Okay, thank you so much for that question. I think it's Johan. Let me just go back quickly to this. Okay, what Johan is saying is, so your name is Johan, right? I think I crammed your voice, sorry.
It's John, yeah.
Yeah. What John is saying that would our okay, remember when you when you paid somebody well in advance, that person will just become, it's like when you borrow somebody money, that person will be your debtor. Okay, meaning that If we pay 500 Rand on a monthly basis, obviously we are 2 months ahead in the next financial period. Okay. So it means that company owes us 1,000 Rand. Should we say, no, we no longer continue with you in terms of our insurance contract? You get what I'm saying? Even in the current year, it's still possible because you can pay that amount of money. Let's say, because our year starts in January, let's say you pay that advance like in April. As long as the service is actually not rendered yet, it means that person is liable to pay you back that amount of money. Of course, in real corporate, they will tell you about the penalties and all of those things. But the fact remains that person owes us that amount of money, whether it's actually in the current year or in the future periods. I'm not sure if that answers your question, Igor.
Yes, that's perfect. I just wanted the sort of long-term view on it, but it makes sense. That's great. Thank you.
Thank you very much for that. Well, let's have a look at, we've seen the recording in terms of the prepayments, and now let's look at the issue of an accrued. Accrued relate, it's an expense relating to the current financial period, but unpaid at year end. Right, look at what is the opposite of your advance payment, the prepayment, which is accrued. Basically, what happens here is at the end of the financial period, we realize that we have an unpaid amount that is actually due when we close up the books. Okay, it's very common. It happens most of the time. So I put an example here. I don't know if you guys can see that because it's actually in smaller, what is it? I don't know, it's a font or what. Okay, it was established that Telkom shows an expense amount of 2750 at the 31st of December 2021. And we closely examined with an approval that in December, the payment did actually not take place. I just don't want to go through to the solution, but I just want somebody to show me how the recording process would work in this one. Anybody with an idea here? Anybody with an idea? Who should I pick up? Nicole Andrea Lot. Can you give it a try, my dear? Any idea? Okay, don't tell me. Okay, don't show me on how the process works, but fit me into your understanding of an accrued expense.
Putti,
yes.
Isn't your accrued expense part of your payables, which would go to your current liabilities?
Your current liabilities, yes.
Under your statement of financial position?
Under your statement of financial position. Thank you so much for that. Do you want to go more? Give me more. I just enjoy how you elaborate on this. You're actually on the right track by saying that. There's a bit of a shortage. For me?
Okay. I then think maybe it would then be from...
Let me go back to it. Okay, taking it from here, what do we do?
Wouldn't we also record it as part of in our profit and loss?
Profit and loss?
On our debit side from the general ledger.
Okay. Okay. Can I intervene? Or do you still want to continue?
Yeah, you can intervene.
Okay. No, she's right by saying that that's at a P&L account, there's an expenditure, and that's a statement of financial position as a current liabilities. Okay. That's a good thing that you understand how you have to maneuver this kind of transactions around your components of the financial statements. That's okay. And I'm very proud of you by that, Pumi. Okay? You did exceptionally well on that one. However, when you see a transaction, it's important to do what Pumi did, but it's also important to understand how am I going to break down my figures. Because if you can look at this example, it's different it's different towards your fixed example in the sense that you're not given the monthly payment. You are given the total amount where you need to break up how much could be the monthly payment. The bigger question would be how. Pumi, do you want to take it further? No, Pumi? Thank you.
You've just moved away from your screen. Please show your question again.
Let me just bring it back. Sorry, it's probably this one. Yeah. Is it clear?
I would, since it's at the end of December, yes. I would divide my monthly payments by 12.
All right.
To get that payment for per month.
Okay.
I don't know if that's right.
Okay. You're actually on the right lane. It's just that you just need to go a little bit more in terms of detailing your explanation, because the fact remains we're not given a monthly payment, right? That's something that we have to determine. But the bigger question is the amount of 2750, is it for the entire 12 months or is it for certain months in 12? Right. I'm going to read the question again. It says that it was established that Telkom shows an expense amount of 2750 at the 31st of December, and we closed examine to approve that. In December, the payment did not take place towards Telkom. Right, let's look at the recording now. So we found out that the recording was actually for 11 months, but for us to get there, how much the monthly amount would be, we have to take 2750 and divide it by 11 months. Remember, we've been told that for that 1 month, which is December, the payment has not been shown. Okay, whatever it might be. So recording would be as follows. You'd say 2,750, you divide that by 11, and then you establish that the payment on the monthly basis is due to be 250. That's the one that is actually accrued. And Kumi, thank you so much for trying that. I can see that you missed out on determining or portioning the months, but you made it quite exceptional by saying that it represents the current liability. Can you see that I've noted that in the notes, which is a statement of financial position? I think I said SFT instead of SFP. It's supposed to be like this. Sorry about that. So if you say 2750, you plus 250, it will make a total amount of 3,000 rand. That would represent an income and expenditure for profit and loss. Right. The truth is, when we split the components of the financial statements, when you record the income and expenditure account, which is your statement of income statement, basically, you're going to include the whole amount because we due to pay an amount, we due to make a payment of 3,000 rand a year, all right? But it's only closely examined that we only managed to make a payment of 2750, right? So entirely going to include the whole amount of 3,000 rand, and you're going to show that as your liability of 250,000 because it's still due, not yet paid. Okay. Somebody with a question? I think it's Zitobile. Zitobile Mboga.
Question. I'm so sorry. I thought I was muted.
Oh, no. Okay, then it's okay. All right, but Primi, thank you so much. I'm just impressed on how you progress with your work. I hope you keep it up that way. Right, let's look at our third item being the consumable inventory, which it relates to the inventory left at year end. This is how it works. I'm going to give you an example with regards to the retail store. Let's look at Pick n Pay, for instance. They've got a financial year period like any other retail business, any other business. Okay, so this is how it works. At the beginning of the year, let's assume that there was no inventory. This is the start of their business. At the beginning of the year, they buy all the stock that we see on the shelf. Okay, so suppliers bring them and everything and stuff like that. And what they would do is they've got what's called an accountant who deal with inventory, specifically for inventory. They deal with, okay, there's so much of inventory worth so much that we have received. You understand? As soon as the inventory slowly moves out of the shelves, meaning that by the consumers buying the products, that's how it moves out. And then at the end of the month, or at the end of the day, or at the end of the week, or at the end of the financial period, they're going to look at how much do we have at hand, despite from how much have we sold. This is how much we've got a stock that worth about, let's say, 15 million rand. But out of the 15 million rand, we've sold a stock of 14 million rand. You understand? So meaning that we've got so much item that worth 1 million that is remaining. Okay? So remember when you do the calculations of the cost of sales, that's where it's going to bring you into the issue of my opening stock worth 15 million rand. Okay? Whether any additional purchases that we make in terms of stock, yes or no, it doesn't matter. But how much is my closing stock at the end of the year? My closing stock worth an amount of 1 million rand. Okay, so bear that in mind when you do your cost of sales calculations. You would remember the movement with regards to that. Right, my example goes as follows. I've got pretty limited purchased inventory with an amount of 4,000 rand during the year, and it was found that when doing physical count, inventory valued at 1,000 rand is still on hand. This is exactly what I've just explained. Let's look at how the recordings was done or performed. So there was an inventory of 3,000 rand representing income and expenditure. The incomes of that 3,000 rand would actually raise by the issue that we sold. So obviously we are receiving money, and the expenditure, it means that it's gone. You understand? So it's an income received. Okay, we no longer have this stock. It's gone now. And then the inventory, by the standard, we are told that, I think that's IAS 2. Inventory to the value, okay, inventory that has been left at the end of the financial period, it will be recorded under your balance sheet. Make sense? It's easy, eh? It's very easy. All right, let's look at the issue of the income that we have received in advance. Okay, so the income received in advance in most cases, you're going to record that under your income statement as your additional income. It might be for the rental, it might be for anything else. Okay, it relates to an income received in the current year, which relates to the future periods. Okay, so if you can look at our first example, which we spoke about the prepayments, we made the prepayment for the insurance, which is an expenditure for the firm. And then we are receiving an income this time around from the clients, which is an income for the business. Okay, so let's have a look at how the examples looks like. So Puti Limited rent 2 hectares of land to the Bumbo farms for 16,000 rand a month. And on a closer investigation, it was revealed that at year end, rental for January to March has already been received. Okay, so any take quickly? Any take? John, can you give it a try here?
So we've received, so is our financial year from December to December?
Our financial year end is the 31st of December 2021. It means that our beginning is the 1st of January in the current year.
We've gotten 3 months in advance, right?
We've got 3 months in advance, yes. Received.
Okay.
First, make use of timelines to determine the advance payments. And
sorry, just a moment. Who is speaking now?
Zitugile.
Okay, Zitugile, can I have you next? Let's hear what John says now. I'll come to you just now. Thank you very much.
Okay, so we have 48,000.
What?
We have 48,000 income in advance, right?
Yes.
Okay, which needs to be recorded in the income in the statement, financial statement and the liabilities as income received in advance, correct?
Yes, the income, actually the income received in advance, it will be 16,000 multiplied by 3 months.
Yeah, so 48,000, right?
48,000, okay.
I think more or less. Yeah, 3 times.
Let me just have my calculator quickly with me. 16 times 3. I've got 48. You're correct, John.
Cool, great. Okay, yeah, so 48,000 income received in advance and the current liabilities in the financial statements. And that's that would be a credit to rental income under the ledger income received in advance. Yeah, and then I need to minus that off our totals for profit and loss. That's about as far as I can get right now.
Okay. Okay. I didn't hear you touching base on the income statement, but I think part of your income would go under your. Okay. Basically, it will be 16,000. Okay. You know what? Let me do this. There was somebody who wanted to give it an attempt just before John, but thank you, John, for that one. I think your understanding is way much better on the trends, but I'll break it down as soon as the lady who wanted to speak. After she go ahead. Please go ahead. I didn't get your name, sorry.
So we make use of timelines to first determine the 48,000 Rand.
Okay.
Then we will make the 48,000 rent income. We will, I think, credit on the rent income and then debit income received in advance.
Okay.
Then we will then transfer the rent to profit and loss, but I'm not sure how we do that when it gets to the profit and loss part.
Okay, let me just be on what you just said. You said we debit the income received in advance, so that will be 16,000 multiplied by 12. So we're going to debit that amount. Is that what you say?
With the income received in advance, no, we don't multiply the full 12 months. We only multiply the 16 times 3, which is 48,000.
Okay, that's correct. And then what do we do with 48,000?
So 48,000, we take it from rental income and go to income received in advance.
Income received in advance, yes.
Yes. Yes.
You can go ahead.
I know we're gonna take it to profit and loss, but profit or loss, but I'm not sure how we transfer to profit or loss is my issue.
Okay, that's your issue. Okay, so okay, that's the end of your explanation, right? I assume.
Yes, yes, it is.
All right. All right, thank you so much. Okay, I'm just glad that you can understand the breakdown in terms of which one is which, even though you still need to understand where do you classify that. Okay, so as John said that, and you said that 16,000 multiplied by 3 will be in advance income received. That's correct. But the issue is, where do we find our disclosure in terms of the 48,000 records? I think John mentioned that we need to move it to ISFP and our current liability as 48,000. That will be your current liability, the income received in advance. It will go there. Okay. So sorry, the lady that was speaking now. So what's your name?
Toby.
All right. As Toby, as you said, you were a bit confused about the movement of the 48,000. Okay, the 48,000, my dear, it will go through to your statement of financial position. That's your balance sheet, right? It will go under your current liability, and then you will put the income received in advance. Remember, that's not your money yet. Do you get what I'm saying? Should those people who paid in advance?
Yes, I do.
Yes. So that's why it's a liability. However, the 16,000 rand, just before I go to my solution, is there anybody who want to take a shot here? I think let me not close the other people's understanding. Okay, that's fair enough. Let me bring up my notes there quickly. The recording will be in this way: 16,000 multiplied by 12, right? Which it will be 16,000 multiplied by 12. Sorry, I made a mistake by that. So that's the whole income amount that is fair for the 2021 business recordings. Okay, so it means that I think it's about 192. It's going to be recorded under your income and expenditure account as other incomes. Okay, that's fair and easy and square. We don't owe anybody on that one. There's their rental. They're supposed to pay that as per agreement, right? The 48,000, which you can see it there, that's where you're going to say 16,000 multiplied by 3 is going to give you 48,000 rand, which it will go through to, oh, I did it well. So 48,000 represent the current liabilities under your statement of financial position, and 192 represent the income and expenditure under your profit and loss. All right, but do you get this idea of the adjustment part? Since well we've dealt this part of what's called the adjustments. Do you guys get an idea of how does it work? So you need to look at it in this way. First and foremost, you're going to look at, okay, how old is not the year of assessment, the financial year period. It's 12 months, literally. For any accounting period, it's actually 12 months. It doesn't matter where it started, it doesn't matter where it ends. As long as you can accurately calculate your number of months, that's okay. Then you are done with that part, okay? The adjustment would come into the picture. Was there any prepaid that we made? Was there any income that we received in advance? Okay. The other thing that you need to know is, what is my relationship with my clients? Okay, because you are interested in recording the transaction that belongs to you. You understand? We're not interested in their recordings. They do their own recordings there. We're not part of it. Our part is the movement that happens between us and them. So you need to determine, okay, if it's Putty Limited, me as Putty here, how am I going to record my transactions? And Pumi Limited there, she's interested in how she's going to record her transaction, because totally they're going to be different to what am I going to record, or how am I going to record. Okay, so 190 would represent expenditure, other info under your incomes as an additional income of 192, and 48 will represent the current liabilities under your statement of financial position. Right, I'm going to move on now. So Elizabeth, yes.
Sorry, no. I had my hand up before you move on. So why are we subtracting the 48 from the 192? Because isn't the 192 for the whole year, it would be the 16 times 12, right?
That's very
Which
correct.
gives us the 192.
Yes.
But then it says here, we see that rental for Jan to March has already been paid.
Yes.
So shouldn't we then say over and above the 192, there's the additional 48 that has been paid?
That's very correct. But if we can look at my line item, my first line item told me, I didn't mention 148,000 being recorded somewhere else in the components of the financial. I just show the calculations. It doesn't go anywhere. It doesn't have any effect with regards to your. Actually, if I do this, it won't make any difference. But I think it will make you happy because that's what you're looking for is 192 and 48,000 rands.
No, thanks. It was just I was just a bit confused there. That do we need to support it?
Sorry about that. Everybody else, please do not consider that the first line item. It was just part of my separate calculations. Right, let's have a look at our accrued income. It relates to income in the current financial period, but not yet received. There's an income that is due to you, but you haven't received that. Same applies to an accrued expense. There's an expense that you have to pay, but it has not yet been paid, right? So my example was on the 31st of December 2021, rental income showed an amount of 18, and it was closely found out that 200 rand of the rent was not yet received. Somebody else somewhere else is renting our stuff, and then they did not pay the 200 rand for the rental. Okay, so let's look at the recording. So we said the 2,000 rand represent the incomes and expenditure because we have received that. We expect, even though we haven't received, we partially received that, but we expect that to be in our books. Okay, 200 rand would represent the trade and other receivables. You still at that time, you haven't paid us on time. So as we know, trade and other receivables, it used to be called debtors. So it will go under your current assets and it will be under your statement of financial position under your current assets. Let's move on to our credit losses. It used to be called bad debts. Okay, it relates to the client who does not keep up with their payments agreement with the credit providers. But you've got an account with Truworths. You are expected, you took loans, you're expected to pay a certain amount on a monthly basis. So this is what happens. You fail to pay as per agreement with your credit provider. Okay, let's say we want you to pay 500 rand a month. Okay, so the whole bad debts and debtors and provision of bad debts and doubtful debts and bad debt, written off. It's quite complex in the sense that you need to give it a closer examination in terms of how you walk around it. Okay, so most companies, or if not all, they've established what's called the payment cycles. It goes according to the payment cycles in accordance with how clients pay. They've created what's called their own policies. Obviously, they go out with their own service provider, FSPs and stuff like that. So this is how it goes. You open up an account, and then you agree with your credit provider to say that I'll keep up the payments as you and I agreed in this way. Okay. For whatever the reason, it happens that you jump your installment. Okay. So if the policy says that we regard you as a credit loss or a bad debt, if you jump the installment in 2 to 3 months, they're going to classify you as a bad debt at that time. Or we're going to classify you as a bad debt when we close our books at the end of the period. You're going to be a bad debt. However, you need to be careful because it starts on what's called the doubtful debt. Immediately when you jump one installment with your credit provider, they start doubting you. Do you get what I'm saying? It's the same as when you are late for work. Let's say you are late for work like twice or once, the employer start doubting you. They'll be like, oh, but we cannot depend on you because you seem to be a late comer. So that's what the company established a policy with regards to. You start as doubtful debt. We'll see if the next month this person will pay. You don't pay. You understand? Okay, let's review our policies. The policy says that if you don't pay your installment as per agreement within 3 months, then you're going to be a bad debt. Okay, that's when they would say your account would move to different places or different sections of the firm. That's why you find out that the legal section of the firm, they call you, hey, do you know that you still have an account with us and you're not honoring your payment? Is there any reason? Because you didn't come forward to them and tell them, this is the problem that I'm actually facing right now. I cannot pay you on time. So that's why we get calls all the time to say, you're due, you didn't pay. When are you going to pay? Do you get what I mean? So that's how the issue of the doubtful debt and the credit loss of the bad debts comes into the picture. Then immediately when you take goods on credit, you're a debtor without any negotiations. You are a debtor. So accounting works in this way. Say me, Pumi, John, and the others of you, we go to Woolworths or Truworths. We open accounts. What they do is somebody's going to be responsible for the list of debtors, meaning individually so, all right? And there's somebody who's going to deal with all the consolidated list of debtors. That's why we call it debtors control account. There's no split there. We just combine all the list of debtors, followed by how are they going to pay us in terms of the agreements that we have with them. So that's the whole scenario with regards to the trade and other receivables control account. You need to know how does it start and how does it end, what is the process involved in between, right? Let's look at the examples. So there's a notification that has been received that Mr. Leo, whose client has been liquidated and he owes an amount of 3,000 rand. Okay, that will make you a bad debtor. So the funny part about accounting works in this way. You become a bad debt, and then after a certain time, we write you off. That's what we call the bad debts written off, credit losses written off. And then you later come and say, guys, I remember back there, I had an account with you. I still need to keep a payment on my account. You understand? That's why we have this term called the bad debt recovered. Okay. However, remember initially all the list of the debtors that we have, we combine them and put the amount together and call them the debtors control account. Immediately when we leave Mr. Leo, it's out, meaning being regarded as the bad debt written off. When you do your statement of financial position, we have to reduce that amount of money for Mr. Leo. And then when you do the income statement, the bad debt will just actually increase. It's an expenditure. That means it's a loss for the business. Right, let's look at the recording. The total outstanding debt amount would be reduced with an amount of 3,000 rand, because this person, we don't really expect this person to actually pay us. It will be a surprise if this person comes back later to actually say, guys, I owe you, I want to pay you. Okay, so you've got a current asset section account. It will reduce. That's what I talked about, the total. The trade and other receivables control account, meaning the total amount of all debtors, they're going to be reduced with the same amount of 3,000 rand. Credit losses amount will increase with an amount of 3,000 rand, being an income and expenditure account. So that's your profit and loss account under comprehensive income. So under the bad debt line item, you're going to say the total amount of the bad debts, you're going to minus that one for the bad debt written off. Okay, meaning that we're no longer going to expect you. All right, depreciation. The shoes that you're wearing today, they probably not looking the same as when you get them on the shelf. I'm just giving you an example on that. Okay, what I'm trying to say is at some point in future, your shoes, it'll be, you won't be wearing the same shoes because of maybe they're damaged or they're no longer useful for you to wear them. Okay, same applies to the depreciation. Many of you who've got cars, the car that you took on the dealer floor plan, today they no longer reflect the same cost that you purchased your car with. Okay, that's why we've got what's called the depreciation. We'll deal with a lot of method in terms of the depreciation later on. It's a bit of a complex.
Sorry, I put your hand up, but you didn't hear me.
Oh, sorry.
You didn't see my. Yeah.
Oh, sorry. Rudairo, it's you, ne? Oprah.
Yes, sir.
Oprah,
yes. Yes, sir. I have a question on credit losses. I'm doing both with FAC1502. So I normally see at times they put like credit losses adjusted. How do you do with it when you have credit losses given an amount, then they say credit losses adjusted, then credit losses recovered when it's listed three like that?
Thank you for that. That's a very good question. Okay, credit losses. Okay, initially you would have. Okay, is your question complete?
Yes, it's complete. When I have three like that, which relates to credit losses, like I have adjustments, we said credit losses adjusted, maybe 7,500, and maybe credit losses 3,000, which is on the original breakdown where we have the breakdown of many figures. Then this one on the adjustment.
All right. The adjustment that you've seen on your 1601, was it for the debtors or was it specifically for the credit losses?
It was for credit losses.
It was for the credit losses.
Yeah.
All right. So the credit losses, that's why if you can look at my line item where I said credit losses amount would increase with an amount of 3,000 Rand, being an income and expenditure account. That's actually an adjustment amount because it has to, because credit loss on its own, it's an expense, right? So when we declare opera as a credit loss written off, we have to adjust that as an increase towards our credit loss expenses, right? So initially the company would be like, no, we don't expect this person to actually pay because he over-exhausted our company policy. I don't know if that answers your question.
Yeah, okay, now I understand it now.
Do you get what I'm saying? Okay, I'll bring that again in the next scenario of the depreciation. Maybe it might be quite clear for you.
Okay, thank you so much.
All right, but the adjusted, it would just mean that, okay, this is not complete, but we are completing it now.
Thank you, sir.
All right, let's look at the long-term adjustments. Right, depreciation. Depreciation simply means that the reduction in the cost value of an asset that produces an income for the business. All right, so the entity buys tangible assets to actually produce an income, and they are due for the depreciation on a yearly basis as they are utilized. It's the firm that they decide that, okay, we buy this kind of a car to deliver stuff wherever they go. Okay, so they would say, okay, we are treating our cars that we bought for the depreciation on cost and on the reducing balance method or on the production unit method, depending on the method that they use. However, the method that you use when you prepare the financial statements, we've got what's called the notes. On the notes, you need to tell me that the vehicle purchased on this date, so and so and so, it has been depreciated model, you understand, for a period of, let's say, 5 to 10 years, if I may put it that way. Okay, so what they're trying to say is the worth of the company car in this year won't be exactly the same worth as of next year because of the reduction in terms of the depreciation. Okay, so what you do is, I'm just going to give you an example. If it's cost, basically, if it's cost of about 200,000 Rand, and you say my depreciation will just go for 20% every year, then you just say cost multiplied by 20% divided by 100, and then you get that as part of your depreciation. So in order for you to get the carrying value of the vehicle, you're going to say my cost minus the depreciation that I've calculated for this year, and minus the carrying amount, minus the cost, it will give you the carrying amount, meaning the value of that car at that standing point. I don't know if it's actually making sense. Right? That's why they say that they are spread over the expected useful life, as because depreciation. Okay, I'm sure many of you back in the days, companies used to sell vehicles that are no longer used for production of the film simply because they would just sell it to, it's either sell it externally, but they would start internally first. But okay, our staff, let's sell this to our staff. But most companies are no longer doing that now. I don't know why. And they would just sell there just to have that little income to push the company going, or to add on buying to what's the new car or the new asset that it may be. But example would be as follows. Putin Limited purchased a vehicle worth of 200,000 Rand on the 31st of December 2001, and then we have determined that 40% of estate depreciation. The accounting standard tells us that, all right, let's say in 2022, I just want to start here first. In 2022, you're going to say my carrying value will be 200,000 Rand and you minus 40,000 Rand. I think you'll be left with some of 40,000 Rand. That will be your opening carrying value in the following accounting period. Okay, so it means that if you are disposing your vehicle, you have to look at that carrying value in terms before you can adjust any disposals of your asset. All right. So I just gave you a little example there just to make things easier for you. But you will see that when you do a property planning equipment, it gets a little bit tricky. It's not going to be quite an easy process for everybody when we get there. Let's look on how they record that. The standard tells us that the depreciation, the contra allocation account for the depreciation, it's always your accumulated depreciation, unless otherwise. But we'll look at that into the future when we go through the content. Okay. Right, the recognition will be 40,000. Yes, say 400,000. Sorry, 40,000 represent the depreciation in the income and expenditure account. That will go to your income statement. So depreciation by no choice is an expense. You put that unless if you are required to do the note on property, plant, and equipment. So if you can look at here, I said 160,000 represent the carrying amount to be transferred to the statement of financial position. All right, you will see that. I know some of you might have seen the framework. So the tricky part about your statement of financial position, for it not to balance with your equity and your liabilities, the main problem is actually on the top, because our calculations on the depreciation, in most cases, they ended up being wrong. And that's a huge factor. You get what I'm saying? I know when I was in my high school, what I was doing is, okay, I don't have to do my PPE somewhere else. I'm just going to do my equity and plus it by liability and minus all the small line items of your current assets and non-current assets, and I get my PPE. That's how I used to do it, because it was just a long process for me and I was not even getting anywhere with it. Okay, but you have to do it for you to get marks. Right, for example, they can give you a question to say, calculate the carrying amount of the assets at the end of the year, and they would say 12 marks. It's not an easy mark you can lose. You understand? So they'll give you like maybe 4 different options in different amounts, and then you have to pick up out of the 4. So, but they can say, calculate the carrying amount under your PPE note that is to be transferred to the statement of financial position. It means that, see the framework, the table framework of the statement of financial position mode. You have to do it, and then your carrying amount at the end of the year is the one that is going to be transferred to your property, plant, and equipment. Right. So that brings us to the end of our the second last learning unit.
Uti, would we be ever asked to calculate depreciation based on a monthly basis?
It can only be asked if the company's financial period is on certain months. If it's actually not on, let me rather say yes, it can be, but it will depend on the financial period of the company. If the company started 3 months before the year end, obviously your depreciation will be a portion of the 3 months divided by 12. But they can't specifically say calculate the depreciation for 3 months. No, if it's all 12 months, they can't do that.
Okay.
Yeah. But remember, that's why I said that with regards to the depreciation, it's a bit of a complex concept in a sense that you're going to have your beginning of the year being the 1st of January 2021, and your year end will be the 31st of December this year. And you found out that the firm has purchased the car, let's say in August, in the current financial period. Because the car did not take place, or the asset did not take place for the entire financial period of 12 months. What you do is you take that specific car and multiply it by the percentage given and apportion it with the number of months, the remaining one. Okay? But they would never tell you that calculate the depreciation for that remaining 6 months. You have to know, because the date would tell you on the question. So I hope, Pumi, does that answer your question?
Yes, it does. Thanks.
Any other question? Right. Remember, there are methods to calculate your depreciation, but we'll still get into that. But guys, when we do from topic C up until topic E, things will get a little bit slowly, in a sense that sometimes we'll just do one learning unit for one day, because those are very tough learning units. They're very complex. They need a slow motion. Understand? It's not like your topic A and B will just come and do your accounting equations or your adjustments and stuff. Even though we're still going to transfer the work that we're doing now to the future content. But when we get there, that's where we need everybody else to understand. You understand? So, but I'm glad because I've got 30 hours with you. So that would help us to actually tackle a lot of theory along with the calculations. Okay, so I'm trying to prepare everybody. It's actually easy. It will be easier for everybody if you're always ahead of me on the way, so that I can just come into your pictures and additional. That will make your life much more easier. Okay, but every time if you do join the class and you are not prepared, it's going to make your life much more harder. It's going to be very difficult for everybody. Okay, so accounting is one of those that I think maybe the academics itself, for you to be on the best lane with your leader, you just need to be ahead of the leader. It helps you to prepare the kind of questions that you have to ask. It helps you to understand the part that you haven't understood so that you can be on the same path. And I'm not joking when I talk that. So I know many students, they didn't make it in passing the course simply because they're always behind. Then when you're pressured by time, you get to be confused about, you understand? So I remember when I was doing my junior degree, what I did was I learned to be ahead of my work, even though I was bothering most of the lectures in the main campus, they know me, they'll tell you, this one is gonna come to and ask each and every silly questions that I have. But it helped me and it prepared me to understand my path in terms of academics, because most of the times when I was going to write the exams, I was so relaxed. So most people were surprised by because the day before I write my exam, I do something. I don't touch books at all. It's either I go to the cinema or I go out, but I don't do books at all up until the day or the time I write my exam. You understand? So it was just the issue of, okay, I know, I don't know, and I don't know you. I'm not even going to write you because I don't know you. Do you get what I'm saying? So I always went to the exam with the mentality that I know this part and I'm going to write it and I'm going to excel on it. Okay, so but that was my strategy. I'm not saying that you should start taking break 2 days before you write your exams, but that was my strategy and it was working very well for me. So I rested way enough, 24 hours resting before I wrote my, but it worked. I developed that in my second year up until I did my third year and my CTA, and to be honest with you, it worked for me. Okay, so I would advise you to actually develop your own strategies as well in terms of how you're gonna overcome your exam. And I also knew that, you know, when you're regarded as a slow writer, I'm one of those guys who would write slowly, but because I knew my content very well at the time, to an extent that even if I write out of 60, believe it or not, 55, I'm gonna get it. There's no way I can fail if I do my way. So I was one of those students who didn't have to write out of 100. I never finished any paper in accounting, and I know that I would never finish it in my life. You understand? But I know how to pass because it's one of the strategies that I have developed on my side. I'm literally a slow writer, but I know that what I write is quality. This is our last learning unit, right? So we're dealing with the closing of the procedure. Then we are determining the profit of an entity, and we are preparing the entire financial statements. This whole thing that I'm talking about is a heading there. We did it, right? Determining your profit, we know it's an income statement of an entity, and then you prepare your financial statement. The thing that we didn't do much here since I've started here, with the examples that I actually gave you, it's the statement of changes in equity and the notes itself, PPE notes itself. But we'll get to that one because those are not a problem. It's only the depreciation part can give you a bit of a problem. But that's what build up towards your statement of the note on property, plant, and equipment. Right. So this is how you determine your gross profit. I hope the size is big enough for everybody to see. So we get to your sales, and then you minus your cost of sales, and then you get to what's called the gross profit. So if you don't want to do it the normal direct way, you can open up your T account called the trading account, and you're obviously going to have your debit transactions, and you're going to have your credit transactions to determine your the gross profit. All right. The underline says the sales minus the sales returns equals to the net sales, right? All the sales that you have prepared to your clients, and some of the goods were returned back, they're going to be deducted from your sales because they no longer form part of your income, right? That's why you get your net sales. You see on how this thing worked together. Remember on the learning unit 5, we dealt with the journals, where we have to deal with sales journal and the sales returns journal. So line number 2 here, it's exactly the same thing as sales minus your sales returns equals to the net sales. But profit or loss for the year is derived from the incomes minus your expenses and finance cost. So finance cost is simply your interest on the loan that took place. Okay, if you take a loan from somewhere else and charge you certain percentages, so that's going to be your finance cost. But we'll deal with that when we deal with the practical questions, which can also be performed by the profit and loss statement. It won't be any surprise if they can say do the T account profit and loss statement. But in your head, you just need to know what am I determining. What you are determining would be the loss or the profit. Easy as that. Inventory systems. We've got two systems here of inventory, which is the perpetual or continuous inventory system. So it's recorded as and when the transaction takes place. All right, so inventory purchase is recorded under the inventory account at a cost, or the inventory sold will be transferred from the inventory account to the cost of sales, depending on how the inventory is sold or purchased. So I'll advise you to go to page 119. It might be a little bit different to mine because they did update their study guide, the lectures. And we've got the periodic inventory system. So the inventory here is recorded under the purchases account, and the cost of sales is determined at the end of the financial period. So you also need to go to your page 129 of the study guide. Right, but here's the thing when it comes to the difference between the perpetual and the periodic inventory system. The other one we are forced to open was called the inventory account, and the other one we are forced to open was called the purchases account. So there's definitely going to be questions with regards to inventory in terms of one of the method. Okay, it's either going to be perpetual or it's going to be periodic. But what I know is they are going to confuse you by including what's called the inventory account or the purchases account. So if you don't know which method you are dealing with, you are definitely going to have a problem. Please go to page 1119 for perpetual and go to your 124 for your periodic inventory system. However, there are questions that we will be able to do as well when it comes to that kind of inventory. Right, additional purchase cost. So remember when you determine what's called the cost of sales, we know that opening inventory and closing is a must, but there are additional costs that has to be taken into account in order for you to calculate that. It's like your carriage and purchases, your railage, as well as your customs and excise duty for importation. So it means that whenever the goods cross the border to our country, so SARS are responsible for that. I think they do that at the airport, something like that. So I normally see the customs when I go to the airport. I normally see the customs there. I don't know what's the process, but I know that the cost with regards to the customs and excise duty for importation is there. Well, let's look at what's called the drawings and what's called the donation. Okay. How do you identify that the transaction is linked to a drawings? What's the key word there? Anybody quickly? We did it the last week. How would you know that this is for drawings or this transaction related to drawings?
If they mention that the owner used it for personal use.
If the owner used it for personal use. So it can be cash or it can be stock in the business, anything that relates to the business for personal use. Thank you so much for that answer. Drawings and donation. Inventory taken for personal use under perpetual inventory system is recorded by your debit drawings, and then you credit inventory. And the inventory taken for personal use under the periodic inventory systems is recorded by debit drawings, and then you credit purchases. Guys, I'm begging you, please make sure you know this. You will remember me when you're given that 1 hour when you write home. You would realize that there's more time to page. Okay. Anyway, I've got a question for you now. Looking at the drawings and inventory here, let's look at inventory taken for personal use under the perpetual inventory system is recorded by debit in drawings and you credit inventory. Can somebody analyze this for me? Why do we have to debit drawings and credit inventory? Why is drawings on?
We are debiting drawings because drawings is an expense and it increases on the debit side.
Okay.
And then our purchases, which represent the stock that the business is buying. Since the owner is taking from the stock, that means our purchases, we had purchased, are reducing.
All right, she's saying that, thank you so much, Pearl. She's saying that we debit drawings because it's an expense, and then we credit inventory or purchases because of it's an expense to the business since all the stock has been moved out of the shelf. Do you think that's fair enough? Kuzelet, Musina, please give it a try.
I mostly agree with her because if she's taking out the business, then it means that we're gonna credit the purchases, because this taking out of the business, isn't it? It decreases on the credit side.
Yeah, it does. The business, so it's okay. First and foremost, inventory is it's an asset, and if the inventory is moving out of the business, it will be an expense for the company, right? So that shows quite a decrease, which is why you see it on the credit. So the contra allocation account will be the drawings. It does not necessarily mean, because, okay, drawings, particularly, you can't say it's an expense. It forms part of your equity. Okay. So, but this, no, what I'm saying is drawings, it forms part of your, you remember when I gave you an example or a format with regards to the statement of changes in equity?
Yeah.
Drawings reflected the deductions there. Okay. So in a way, it will be some kind of an expenses, but it forms part of your equity.
Okay, yeah.
Right. So in other words, your equity is decreasing. Does it make sense? So the question is, where does your equity decrease? It's on the debit side, right? That's why you see drawings on the debit side. So the same would apply.
Equity decreases with assets. When the asset decreases, equity decreases as well.
Yes. Okay. Let me put it this way. Remember, the inventory that is actually on the step, which is your stock that is actually on the shelves, should they buy it by any customers there, it's going to increase your profits, right? And then we've been told, or I've told you, that income increases your equity. But immediately when you draw that for your own personal use, it means equity is coming down. Can I repeat? Or is everybody clear on that?
Yeah.
Is everybody clear on that?
Oh, yes.
Yes.
Sorry, my hand is, I'm failing to put my hand up. It's Oprah, ne?
Okay, Oprah, you can go ahead, sorry.
Yeah. I wanted to say the inventories, we are crediting it because it's current assets which are decreasing.
Yes.
Then the drawings is because on the equity side, it decreases. It doesn't increase. So we debit it. That's what I wanted to say.
Oh, that's very correct. You guys all heard what, that's exactly how it's supposed to be. So when you draw stock, that reduces the profit. Obviously, it reduces your equity. That's why you see drawings being on the debit side. Right, despite the system being unused, whether it's perpetual or periodic. Obviously, purchases will just represent what's called the inventory. All right, now let me just explain that again. All right, what Oprah says, it's the reason why you see inventory being a decrease is because the stock has been reduced for personal use. I don't know if that makes sense. Remember, the stock is meant to be on the shelf for the purpose of sale to the clients. So when you sell, it means that you're receiving money. And then when you get money, it means your income is going high, which is the revenue. Okay. Now, because of, in a way, they are taking the money, which is stock. It's going down. It's for the personal use. The firm is actually not gaining anything. I don't know if that makes sense. That's why you see inventory on the credit side. So the drawings, it goes along with the inventory. Remember, when the income of the business goes high, your equity would go high, right? So now the income of the business is no longer going high. It goes down. So that means there's a reduction in your equity. Everybody is clear on that. Okay, but I'm glad one of you is getting it right. But I think when we do questions, you would hardly have questions with regards to the donations. But should we have any questions, I'll try to drop something for you just for next week, so that you see what I'm talking about. But that's actually in a nutshell. Okay, I've identified and noticed that you guys are not clear on this part, but I'll make sure that I'll explain sometime in the future. Right, we've got donation of the inventory under your perpetual inventory system is recorded as donation, and we also remember in inventory it will always be under the decrease, because it's either you're taking it for your own consumption or you're donating it, but it has to be that way. While under the periodic inventory system, donation as well as the purchases. So purchases basically it just represent your inventory because it's a different inventory system that are used. Okay, let's have a look at the closing of the nominal accounts. Okay, so those who've got an accounting background, we used to get marks for nominal accounts. Nominal accounts in high schools, they used to be represented by N. So you know that your revenue is probably N1, N4, N whatever. You get what I'm saying? But when you get to your tertiary, you throw the thing away. It's no longer working. Okay? And then your statement of your financial position. So the nominal accounts used to be represented by B because it deals mostly with the assets and the liabilities and the equities. So you'd have your B1, B2, B whatever there. But we don't care about that anymore. Okay, it's gone. Right, so determination of these would be closing the journals and transferring the amount of the trading account to profit and loss accounts. Or somebody wants to speak, sorry to come ahead of you. Because that's basically your trial balance. So we can prepare financial statements after doing everything else, from the journals to the ledger accounts and your trial balance. Then you can just close off things with your preparations of the financial statement. Trading account, it's used to determine the gross profit or the loss. Profit or loss statement used to determine the net profit or the net loss. And then afterwards, you remember when we were doing learning unit 6, where, sorry, it was 5, I think, where we're dealing with the accounting cycle, where the transaction starts, the process up until the prepare of the financial statements, somebody will just come and analyze, and the management will make decisions. This is where we are now. You understand? We are actually at the point where we have to prepare the financial statements. Okay. And we'll see more and more on this, on the notes. And that brings us to the end of our session for today. Okay. Your trial balance and your whatever, in most cases, they'll just give you that for the starting point of your required part. Okay. So I'll open up for questions afterwards. There's one thing that I want us to agree on. I need to set a quite comprehensive question, right, on my O, and then next week we're going to tackle that one. We're not do for the 2 hours that you and I are going to share. We're going to tackle it. We're just going to do anything from the accounting equation, and we do the journals, and we do the T accounts, and we do the journals and the ledger accounts and all of those. I don't know if you guys can just bring everybody in the picture. All right. I want everybody else to unmute yourself, please. Because now we're engaged. You guys heard what I said, right?
Yep.
Yes.
I'm going to examine a very comprehensive question, right? Just for you and I. The next week we're going to focus on that. There we'll cover topic A and B, the entire topic of A and B. Okay. So we are all going to, for the sake of time and respect, we are all going to participate on that one. Nobody's going to be on mute like we used to be or we are. And then from there on, we're going to proceed with our topic C, D, and E. Make sense?
Yes.
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 Please bring your books and your pen and your calculator and your highlighters and your pencils.
Are you going to send that prior to the class?
No. What I'm going to send prior is the message to say go study. So it's more like an exam. They don't send you the paper prior. You just go there and start with an exam. It's going to benefit you, believe me. We never did this since I've ran this kind of sessions in accounting and tax. We never did this in any other class. And I've been with the students for about 4 years now. So we never ran something like that. But I've just decided that it would be important for you to do that kind of a question. And remember, we're still going to have about 4 hours of revision.
Puti, do you know which more lessons assignment 3 is going to be based on?
I'm not 100% sure, but
It's, can I speak? It's 10 to 14. So it's 10, 11, 12, 13, 14.
All right, the answer is 10, 11 up until 14, basically.
Thanks.
I wish you all the best for the coming week, and I hope you had the best previous week.